Developers across Vancouver are panicking, quietly, privately, and in some cases, desperately. Not because construction stopped, not because demand vanished overnight, but because thousands of brand new condos are finished, sitting empty, and bleeding money every single month. These units are not showing up in the numbers most people look at. They are not flashing red on market reports. They are hidden in plain sight. And that hidden inventory is creating pressure we have not seen in this market in decades. Once you understand what is actually happening with these units, why they are not selling, and why developers cannot simply cut prices and move on, the panic starts to make a lot of sense. That is exactly what we are breaking down today. Now that context matters because the panic is not coming from headlines or media narratives. It is coming from the balance sheets. At the core of this problem is a growing pile of finished condos that developers cannot sell and cannot ignore. These are not theoretical units or future supply. These are real buildings that are already complete and already costing money. Right now, thousands of brand new condos across Greater Vancouver and the Fraser Valley are finished, sitting empty, and producing zero income. They are fully operational buildings with elevators running, strata councils formed, and monthly expenses piling up. But there is no occupants and no buyers stepping in fast enough. What makes this situation especially dangerous is that most of these units are invisible to the people watching the market from the outside. They do not appear in the sales numbers, they do not show up in active listings, they are not reflected in months of inventory. So while the market may look slow or stable on paper, the reality underneath is far more stressed. The best estimates right now suggest between 2,500 to 3,500 completed condo units that are totally vacant and unsold. That level of finished inventory has not been seen in over 25 years, and every single one of those units is costing the developer money every month it sits. There's interest accruing on construction loans, there are property taxes due, there are insurance premiums, strata fees, and maintenance costs. Without rental income or sales revenue, these units are not assets waiting patiently for the right buyer. They are liabilities that grow heavier with time. And that is the pressure point that explains why developers are panicking right now. Most people track the market through monthly stats like sales, active listings, and months of inventory. Those numbers all come from MLS data. Here's the problem. Developers do not sell these units on the MLS. They sell them quietly through sales centers, internal broker networks, and off-market conversations. Because of that, these completed units do not show up as active listings and they do not inflate months of inventory. This is what people mean when they talk about shadow inventory. When you combine visible resale inventory with thousands of invisible completed units, you start to understand why developers are under so much pressure. Buyers might not see it in the numbers, but developers feel it every single month when the bills come due. This problem is not evenly spread across the region. The pain is concentrated in areas that were built heavily for investors over the last cycle. Places like Surrey Central, Brentwood, Metrotown, parts of Langley, and pockets of downtown, along with Burquitlam and Coquitlam. In these areas, tower after tower was designed around small investor-focused units, studios, micro one-bedrooms, and compact layouts priced on assumptions that no longer exist. During the pandemic era, money was cheap. Interest rates were low, financing was easy, developers borrowed aggressively and built aggressively as well. Investors piled in because the math worked at the time. Many of these units were pre-sold at $1,200 to $1,300 a foot. That pricing only made sense if interest rates stayed low and resale values kept climbing. Neither of those things happened. Today, buyers look at the resale market and see larger, more livable condos selling for under $1,000 per square foot in many cases. Once buyers see that, it becomes very difficult to justify paying a premium for a smaller pre-sale unit. On top of that, interest rates are much higher. Insurance costs are higher, strata fees are higher, and rents have not risen fast enough to cover the carrying costs. In many cases, the numbers are completely upside down. Monthly payments can easily be over $1,200 while rent sits at $1,900 to $2,000. That is negative cash flow with no appreciation story to rely on. So investors step back, end users hesitate, and developers are left holding thousands of completed units that cannot move. That is where the panic sets in. A lot of people ask why developers do not just lower prices and move on. In many cases, they simply can't. These projects are financed based on projected values tied to appraisals and loan covenants. If a developer publicly lowers prices, lender demands new appraisals. When those appraisals come in lower, loan-to-value ratios change and covenants get breached. Once that happens, lenders take control, financing can be pulled, refinancing becomes impossible, and projects can be pushed into creditor protection or receivership. That is why developers are trapped. They cannot sell at today's market prices without risking their financing, but they also cannot sit on empty units indefinitely without bleeding cash. This is why panic shows up through incentives instead of official price cuts. Free parking, free storage, cashback on completion, mortgage rate buydowns, covered strata fees, buyback guarantees, assignment flexibility, and in some cases, very large off-the-book discounts that never appear on paper. These are not signs of creativity, they are signs of fear. Before we move on to the next point, if you're finding this interesting, then please subscribe to the channel and like the video. The impact of this situation does not stop at the sales center. When developers slow down or stop building, trades lose work. Electricians, plumbers, framers, drywallers, concrete suppliers, and lumberyards all feel it. Construction is one of the largest employment sectors in BC, and when it slows, the entire economy feels the effects. Employment drops, municipal tax revenue declines, infrastructure projects get delayed. This becomes a broader economic issue, not just a housing problem. At the same time, we are in a standoff that will likely define the next 12 to 24 months. Developers cannot cut prices too far without triggering financial problems. Buyers see falling prices, rising inventory, and better resale value and feel no urgency to step in. Both sides wait, but time hurts developers far more than buyers. Every month that passes adds more pressure to those completed units. That is why the leverage in this market is concentrated around finished inventory. Looking ahead, developers with the wrong product in the wrong location and the wrong capital structure are going to continue to suffer the most. You will likely see more quiet discounts, more stalled projects, more layoffs, and more distressed situations. At the same time, fewer new projects will be launched, and that sets up the next phase of the cycle, where today's oversupply eventually turns into tomorrow's shortage. Just not for this type of product. The investor-grade condo boom is over. End-user-focused housing will survive, everything else will have to reprice. Developers are not panicking because the market is slowing, they are panicking because the math has broken. Cheap money is gone, future pricing assumptions failed, and thousands of empty condos are exposing just how fragile this cycle really was. If you're a buyer looking at this type of completed developer inventory, this is where things get interesting. The most important thing to understand is that completed units are where the real pressure is. Developers can delay launches and pause future projects, but they cannot make finished units unfinished. Every month those doors stay closed costs them money. That means you have leverage, but only if you use it correctly. First, focus on completed buildings rather than new launches. The pain is already baked into those projects. Developers holding finished inventory are far more motivated than developers selling future product. Second, understand that the list price often does not tell the full story. Many of the biggest concessions are not advertised. They happen quietly in the form of credits, upgrades, paid carrying costs, or off-the-book price adjustments. This is where having proper representation matters the most. Third, underwrite the deal based on today's reality, not yesterday's peak. Compare the unit to similar resale condos in the same area. Look at price per square foot, not just the total price. If resale is cheaper and more livable, use that as leverage in your negotiation. Fourth, do not be afraid to negotiate aggressively, but be reasonable. Developers are sensitive to anything that threatens their financing, so creative structuring often works better than headline price cuts. Things like credit on completion, strata fees paid for a period of time, or mortgage rate incentives can materially change your outcome. Finally, patience matters. This is not a market where you need to rush. Time is on your side, not the developers. The longer units sit unsold, the more pressure builds for them, and therefore you can get better pricing. For buyers who understand what is happening, this is not a moment to panic. It is a moment to stay patient, stay informed, and move strategically. Thank you for watching. You can subscribe to the channel here or watch another video here.